Good morning. In this section, we will be discussing about the value at risk model, particularly in the foreign exchange market. As I mentioned in our earlier session, exchange rate fluctuation is a risk for the exporter importer. If the exporter importers are not purchasing any risk management product, their position is open. In open position, any fluctuation in exchange rate create risks, and how much risks they are bearing in their position, you have to estimate that. That estimation is generally you do in the finance through value at risk. So, value at risk is applicable to foreign exchange market, to bond market, to any position whenever where the underlying is a asset, which asset value is fluctuating. Before discussing about the value at risk, you have to understand some amount of little bit statistics about standard deviation, normal distribution, and also the portfolio risk estimation side. Let us start. Value at risk indicates what is called value at risk. Value at risk indicate the potential loss of asset value over a period of time. What does it mean? Potential loss. There is no loss so far. We are using the historical data and estimating some parameter. Through the parameter, we are estimating what will be the potential loss. Actual loss has not taken place. For asset value, the asset may be foreign currency, may be a bond, may be any kind of financial asset which value is fluctuating with a given level of confidence, because when you estimate something about the future, you are estimating your potential loss, you are estimating. So, we are not confident actual loss will take place, we are confident on certain degree. The degree of confidence is very important here. The degree of confidence we will be estimating through the normal distribution. The value at risk applicable to asset which are highly volatile in nature. The value of the asset, value at risk is applicable to asset. The asset value is fluctuating, highly volatile. Generally foreign currency is highly volatile, equity prices are highly volatile, bond returns are highly volatile. So, they are applicable to such kind of asset which underlying value is fluctuating. The value at risk is used for individual asset and also for a portfolio. What does it mean? In one single foreign currency you can use, or a combination of foreign currency, US dollar, INR, Indian, maybe in yen, French franc, euro, a combination of currency, and we are designing a portfolio, that also we can use the value at risk for the portfolio variance, portfolio value at risk. For estimation of value at risk, we have to estimate what is the return. Return fluctuation is important here. So, where calculation or value at risk calculation, we need to find mean of daily return and its standard deviation. The mean of daily return, after calculating estimating the mean of daily return, we can convert into weekly, you can convert into monthly, you can convert into yearly also. So, you have to take the daily returns. Return is nothing but tomorrow price minus today price divided by today price, you will get the return. So, here S1 price of the asset on day I and S1 minus 1 price of the day previous day, and S1 minus I divide by that, we will get return. What does it mean? The return is here, when you calculate the return is here, RI is equal to S1 SI minus SI minus 1 by SI minus 1. Here what does it mean? Suppose here we are calculating 53 rupees per dollar today, yesterday 52 rupees divided by 52 rupees, will get the return to us. Return will be in percentage form. So, return is nothing but today minus yesterday divided by yesterday will give the return. So, this return is daily return because every day data we are taking. After getting the daily return, we can convert into yearly return, can convert into monthly return, we can convert into any other day return over a period of time. So, in value added risk, two things are very important, what is called mean return and standard deviation. The mean return is what? Nothing but if you calculate daily return for RI, if you calculate RI I is equal to 1 to 20 means first day, second day, third day, fourth day, all day returns you are till 20th day, the mean return will be nothing but I 1 to 20 divided RI divided by n is here 20. So, what we are doing here? I were calculating R 1 plus R 2 plus like this R 20 divided by 20 will get the mean return or R bar square. This is mean return calculation side. Similarly, in value added risk we also need what is called a two more thing, what is called standard deviation of return. Standard deviation return we are calculating by after getting the mean return, you have to calculate the standard deviation of return. Standard deviation return is the variance of the series. The variance, as we know, is nothing but 1 by n individual return minus the mean return square. So, this is your we get the standard deviation of the return. Individual return minus the mean return, how much the individual return are deviating from the mean return, that is called the variance or the risk or the volatility of the return. When you call volatility of return is nothing but deviation from the mean, any deviation from the mean is a risk, and the risk you are capturing through Ri minus R bar, and the risk is standard deviation, and standard deviation generally used for the risk calculation side. Once, because these are returns are daily return, but you may need for weekly, for me may need for monthly return. Then question is how you can calculate value or variance for the period over a period of time. So, variance over a period of time, so we call variance at a period of time t period, nothing but sigma square the variance and into t. Suppose we know this daily returns we know for 7 days return, daily return into 7 days will be the 7 days variance. 1 month return, suppose you know daily return, we are calculating what will be the variance for the 30 days, you multiply by 30. So, similarly, standard deviation is nothing but the value sigma into root over t. So, for t period, t is suppose 1 day, 2 days, 3 days, 10 days, whatever days it may be. So, if you know the standard deviation of daily return, standard deviation into root over t is the time period number of days, you can calculate the volatility of return for t period. T may be 1 day, 2 days, 3 days, 10 days, 15 days, anything. Okay. The volatility of return calculation. When I mentioned that in case of value added risk, we need 3 parameters. The first parameter is your volatility, second parameter is your time period, third parameter is confidence level. So, we will be discussing each of. What is volatility? I mentioned here volatility is a risk. Risk is coming from where? In case of foreign currency, the exchange rate volatility. Exchange rate is changing its value, US dollar and Indian rupee. Rupee is depreciating, appreciating every day. So, there is a depreciation, appreciation is a risk. The risk you are capturing through the standard deviation, and the standard deviation is nothing but volatility. Then you generally do the time value added risk for some time period, because when I purchase a foreign currency, I may keep it for 10 days. So, I am bearing 10 days risks. Within that 10 days, the foreign currency may fluctuate, it may be appreciate, may be depreciate, and there is a risk. A 10 days risk I am keeping with me. So, I have to calculate the risks here, the volatility for 10 days. I have to take the data for daily data, for 240 days data, 1 year data. From the 1 year data, I have to calculate the value at that is the 10 days variance, and 10 days variance will give me the 10 days risks of keeping the particular currency for 10 days. The time period is the number of days, because without reference of any time period, we cannot calculate the values, volatility or the risks. Confidence level, the confidence level is here nothing but how much confidence I am, the volatility will remain the same which I have estimate. I have taken a historical data, the historical data, on that basis of historical data I have estimated the volatility. What I am using the historical data volatility for future prediction. What is the confidence? The history may repeat itself in future. So, that is called confidence level. I have a confidence that same kind of volatility will be there in future also. My confidence, suppose I am 99% confident. So, same kind of volatility may occur also in future, that is called confidence level. So, it may not be same kind of volatility, because it may happen history may not repeat itself. It may happen that the volatility may be less than the earlier volatility. So, it depends upon the confidence limit what I have with me. So, T var, time value, T var means number of 5 days, 10 days var, T var is equal to 1 day var into root over T. What does it mean? Suppose I am calculating the value at risk, variance value at risk for 1 day, value at risk for 2 days, value at risk for 10 days, T var 1 day var value at risk into root over T. Okay, that will give me that value at risk for that many days of var. T var 2 days var, so 1 day var I got, so 1 day var into root over T, for I will get the var for second days, third days, 4 days, whatever it may be. What does it mean? It means that I am here, suppose I got T var is nothing but 1 day var into root over T. Here T is suppose 14 days, 2 weeks. So, T 14 days var is nothing but 1 day var, I know 1 day var into root over of 14. So, that will give you the 14 days var. 1 day var I have used a yearly data and estimate that every day, yearly data means each day data, and estimate the volatility and estimate that value at risk. Suppose I want to keep my position for 14 days, and what will be the what is the risk I am carrying for 14 days, because I use the 1 day var and I convert into 14 days var. So, that is called var over the period. So, there are another problems also there in a what is called portfolio vars, because it may happen in my portfolio I have number of assets. Number of assets has a own weight in the portfolio. Each asset is a own weight. Each asset has its own volatility. So, portfolio risk is combination of all this volatility. So, the question is here, how I have to estimate the portfolio risk. So, you have to calculate, you have to understand what is a portfolio first. A portfolio consists of number of individual assets. Each asset is own volatility. Return on asset may have some degree of correlation also. It may happen that rupee and pound sterling may correlate. And rupee is depreciating, pound sterling may depreciate. Rupee is appreciating, pound sterling may depreciate. That may be positive or negative correlation among the currency. Similarly, when a portfolio have 4 assets, each asset, individual asset, among them there may be positive negative correlation. So, suppose the negative correlation may reduce the volatility, portfolio where portfolio risk, positive correlation may increase the portfolio risk. So, I always try to reduce the portfolio risk. So, portfolio risk can be reduced by having negative correlated of individual asset. So, returns of asset may have some degree of correlation. Returns of asset have some degree of correlation. I have to factor the correlation while estimating the portfolio where. The aggregation of standard deviation, but how I am doing this portfolio risk calculation? I have to aggregate the individual asset standard deviation and I have to factor the correlation among them. So, I have to estimate what is called a portfolio standard deviation. So, portfolio standard deviation as we studied in corporate finance where the correlation is very important among the asset. Individual asset their own weight, individual asset their own volatility, along with the correlation among them you have to factor to estimate the portfolio where. But what is correlation? Correlation what we discuss, what we have understand from the statistics, correlation is a degree of association among assets, among returns. The degree of association may be positive, negative. So, hence correlation varies from plus to minus 1, plus 1 to minus 1. They represent maybe positive correlation or negative correlation. The highly correlated and so is a positive 1 correlation, very negatively correlated may be negative minus 1. In between this plus and minus the correlation stands. So, 0 correlation there is no association. Generally in a portfolio we want to minimize their risks, we generally have a negative correlation among assets, individual assets, so as to reduce the portfolio risk. When you discuss about portfolio risk, you have to combination of standard deviation is very important here. Here suppose there are 2 assets here x and y, 2 variables, 2 assets, 2 individual assets. The portfolio is composed of the portfolio having x and y 2 assets, and the volatility of individual assets, the variance of asset, the volatility, the sigma x square is the volatility or the variance of x asset, and sigma y square will be variance of y asset, and among these 2 x and y there is a correlation between x and y I refer is x and y. Okay. Then the portfolio have a some amount of money, I suppose x composed of the x has a weight of w x and y has a weight of w y. So, when you w x plus w y if you include it will be 1, w x per w y is equal to 1. The x is the weight of w x, y is the w x y. Now, once you know this, you have to estimate that portfolio standard deviation. So, portfolio standard deviation as per the calculation goes, portfolio standard deviation is nothing but sigma x y square. Sigma x y square is nothing but sigma x square into w x square, sigma y square into w y square plus 2 into w x w y and sigma x sigma y and x y the correlation among these 2. So, what is this individual asset volatility into weight of the asset, this 2 has come, and correlation among these 2, that is x y rho x y and standard deviation between 2 along with the weight, the correlation part will come over here. So, the if the asset x and y have positive correlation, then this part will be positive and this part will be positive and overall standard deviation will be more. If the asset x and y have negative correlation, then this part will be negative and overall standard deviation or overall portfolio variance will be less. So, it depends upon the designing of the portfolio, what kind of you have to decide the asset quality or asset return relations. Generally, to minimize the portfolio variance, we should always have a such kind of individual asset which correlation is negative, so as to reduce the overall portfolio variance or portfolio risk. So, in the estimation of value at risk for a portfolio of asset or portfolio of currency, you have to see the individual currency standard deviation, individual currency weight in the portfolio, and among this currency what is the relation or correlation among them. Plugging all this parameter, we can have the portfolio standard deviation or portfolio volatility or portfolio risk that we have to use for calculation of value at risk. Okay. Now these two things we have got. One is got time period is our T, we can come time period is our T, which can be 1 day to 1 year, and we know how to adjust it. Then we have individual volatility nothing but standard deviation, which is nothing but deviation from the mean. We can calculate for individual asset, we can calculate for the portfolio of asset. Now, third thing we need confidence interval, because we have to operate in a normal world. We are estimating that the volatility of a asset or a group of asset have a normal distribution. By assuming the normal distribution, only we can proceed further. Okay. So, what is normal distribution? The normal distribution is nothing but the asset volatility spread over in such a way the curve will normal shape in nature. The mean, mode and everything that the asset volatility spread over the mean. So, mean is the central part of the here and volatility spread over the mean and uniformly distribute. There is a bell shape here. It is not extreme volatility or not a volatility which cannot be estimated from here. So, mean of standard deviation and the mean and standard deviation design what is called the Z score. That Z score is here, Z is equal nothing but x minus x bar by standard deviation. On this basis, we will design the normal curve, and this using this curve we will design what is the confidence interval, because why we need confidence interval? We are using historical data. Using the historical data, we are predicting for the future. So, what will be the probability of loss in future, which on the basis of what? Historical data, historical volatility. We are assuming that historical volatility may repeat in future, but it may not be the 100% repetition. Some extent it will be more volatile, future may be more volatile than the past. It may happen the future will be less volatile than the past, but our underlying assumption is that history repeat itself, but there is a confidence history may not repeat same way. History may repeat 70, 80, 90 or 99% of past. So, like that, on the basis of, because since we are using historical data, we are not confident enough or 100% confident same kind of volatility will be there in future. So, we have to design a confidence interval. The confidence interval is here through the normal distribution. What normal distribution here? The mean and the standard deviation or the volatility is important for the normal distribution. We are assuming that the volatility distribute across the mean in such a way the curve is a uniform normal curve which is a bell shape in nature. And after that you can design the confidence interval on the basis of volatility, mean plus volatility, mean plus volatility. Okay. Now, if you see here, if you are 99% confidence the history may repeat itself in future, that we are somewhere mean minus 2.33 standard deviation, that is this point to this point, mean plus 2.33 standard deviation. 99% we are sure the mean will the volatility or historical volatility will repeat in future. Suppose you are 95% sure, here the distribution of standard deviation is such that it is mean minus 1.65 standard deviation from this point to mean plus 1.65 standard deviation. Here 95% confidence interval, the history will repeat itself, the same volatility will continue in near future. Then here in third sign, here the mean minus 1 standard deviation and mean plus 1 standard deviation, here 68% of the curve area we are capturing, 68% we are confident the history or same volatility will be there in near future. So, these are the calculation of confidence interval through mean and standard deviation using the normal curve. Now, suppose some important results here, assuming the normality, mean and standard deviation generate the following result. So, mean is 1 standard deviation spread across two sides. What does it mean? We have discussed earlier, the mean is spread over 1 standard deviation, the third curve, the curve 1 standard deviation left, 1 standard deviation right of mean is cover 68% of the curve area with 68% confidence that history may same volatility will continue in the near future. And here mean plus minus 6.5 standard deviation, it covers 95% of the whole distribution. If you see here the second diagram here, plus minus mean minus 1.65 standard deviation, mean plus 1.65 standard deviation, which cover 95% of curve area, 95% we are sure, we are confident that history may repeat near future. Mean plus minus 2.33 standard deviation, here the 99% curve area we are capturing, mean minus 2.33 standard deviation and plus 2.33 standard deviation, which cover 99% curve area, that means 99% you are sure our history will repeat same way, 1% we have a problem. Now, come to the where side, value at risk side. The first diagram were 99% sure history will repeat itself. So, probability of loss is 1% here. Similarly, probability of loss is 5%, when 5% we are not sure. Similarly, probability of loss, suppose here 32% we do not sure, we are not sure. So, here same way you can calculate the value at risk model. Now, so what does it mean? It means that two things here. First, 1 standard deviation covers 68%, one tail confidence, this means 32%, one tail 32%. So, curve area is confidence interval 84%, cover area is 95% here when 1.65 standard deviation. Similarly, 2 standard deviation cover 95%, here cover area is 95.78%. Similarly, 2.33% we are sure. So, the one tail here cover area is 99.5% standard deviation. When you discuss about, when you decided that about the calculation process of volatility, the conversion of volatility, day volatility into a period volatility, then we discuss about confidence interval, These three things as I mentioned from the beginning you required for the calculation of value at risk. Once you decided about the three things, now we discuss about value at risk calculation. The value at risk, as I mentioned from the beginning, is expected potential loss, not the actual loss. We are not discussing any actual loss here, we are discussing potential loss. Why potential? Because we are using the past historical data to predict the future. So, we are predicting the future, future has not arrived to us, all our calculation are expected potential. So, expected potential loss on account of change in market price. So, your market price, suppose your foreign currency US dollar Indian rupee, the fluctuation of Indian rupee against the US dollar. So, change in market price on the given exposure, our exposure amount, how much? 10 million on a certain period of time, means how many days you are keeping the 10 million, 10 days, 15 days, certain period of time. So, we understood here three parameters: expected potential loss on account of market price volatility, US dollar Indian rupee is fluctuating, the volatility is coming from the fluctuation side. Exposure amount, how much US dollar we are keeping, 10 million US dollar. So, amount is exposure P0 10 million US dollar. How many days you are keeping? Suppose 10 days, the period of time 10 days here. So, everything has come over here. So, value at risk nothing but you have to multiply all these things too, all three things. P0 is our exposure 10 million, B0 is a volatility of Indian rupee and US dollar, that is rupee is fluctuating, V0 volatility of rupee, and H0 holding period, that T is coming over here, holding period. All these three things if you multiply, you will get our calculation of what is called value at risk. Now, question is here, we know what? We know P0. P0 amount 10 million, 20 million, 30 million, what is the portfolio size, what is the size of our holding, 10 million US, we know it. We know holding period, how many days you are holding, you know the holding period. H0 we know. What you do not know? We know the V, you do not know the V0. The volatility, you have to estimate the volatility using the historical data of rupee dollar exchange rate. Here rupee is fluctuating, you take 240 days or 1 year daily volatility, daily exchange rate of Indian rupee, and estimate is variance or variance of standard deviation estimate, that will give daily standard deviation or the daily volatility. So, the calculation of V0, the volatility only can give the skills or estimating the V0 correctly. The how, what way you are estimating V0, what is the process you are adopting the calculation of V0, that determine our value at risk calculation, because in value at risk calculation all other things are given value. Given, what is value at risk calculation? We know that value at risk calculation we need what is our exposure, that is P0 into V0, V0 is volatility, and we also know what is called H0, H0 is the holding period. So, P0 is our exposure, exposure is our amount, we know the amount, and H0 is our holding period, holding period, how many days you are keeping, suppose amount is 10 million US dollar, 10 million US dollar, how many days, pre-holding period days, suppose 10 days, you know this, 10 days, we know this, and V0 is the volatility, this we do not know, you have to estimate. So, everything for us is the given value, only this thing is not given to us, we have to estimate. How we estimate? You have to take, suppose you are handling US dollar in Indian rupee and US dollar calculation, then suppose US dollar 53.5050 is 13 days. You take a series of number of days, generally maybe around 240 days data, everyday data, and see what is the fluctuation. Calculate the exchange rate for 240 days, the historical data, and estimate the standard deviation of this. That will give you the volatility calculation. So, what we are estimating the volatility, that only give a good VAR to us. The VAR is good, the prediction is good, the volatility prediction is depends upon the what way you are predicting or estimating the volatility. So, suppose here one example is here 1 year rupee. Suppose you have taken 1 year rupee US dollar and exchange rate. Suppose now we are estimating the VAR. What we have to do the VAR? In Indian context we have the working day. So, suppose you are estimating the US dollar and Indian rupee exchange rate volatility calculation. So, you have to take a working day. In India we have suppose around 240 working day. If you in a foreign exchange market 240 working day data you will get, because Monday to Friday generally exchange rate market in India works, Friday also, Saturday also it works, but Saturday the transaction not so much, you may not get the conversion rate, but you can include Saturday also. So, Monday to Saturday data if you see, if you remove the holidays, it is 240 working days will get. Take the daily exchange rate of Indian rupee, US dollar, exchange rate of US dollar in Indian rupee. So, that starting from day 1 you go up to how many days? 240 working day. Then take its mean calculation, mean will be there. Then after that estimate the variance is nothing but 1 by 240 into x minus x bar square, that will give you variance. After estimating the variance, we got the volatility here, the volatility standard deviation of volatility is here, and this will be helpful our calculation of VAR. Now, suppose the volatility we estimate, the mean is, suppose here we got the mean x bar of, suppose we got the mean of x bar something around 49.3350, and you got the standard deviation of suppose around 0.6918, and the position is here. Our position is a two sign, one is days of position, days, suppose days, our day, suppose we are going for 1 year calculation. So, our day also we got, this is daily volatility. So, a daily volatility 1 year. So, you have to suppose daily volatility, suppose you got in place of 1 days we calculate suppose 14 days, 2 weeks, nearly 2 weeks, 14 days. Position one is in position, one is date, another is amount. Amount is, suppose our amount is 10 million US dollar, 10 million USD. So, we got the 10 million USD, we got the mean calculation, we got the standard deviation calculation. So, standard deviation is our here, our mean also we got, standard deviation we got, position we got the position for 14 days, we got the amount for 10 million. Now, we have to calculate the VAR. VAR is here, when you calculate the VAR, what is our requirement? The VAR is, as we discussed earlier classes, earlier slide, VAR is nothing but P0, that is position, then V0, that is volatility, and also you have to calculate what is called holding period H0. Now, P0 is our 10 million, volatility volatility we have estimate the daily volatility you have done, daily volatility is 0.6918. So, we have to calculate 10 days volatility. So, T is equal to 14 days volatility, T is equal to 14 days. So, the volatility calculation is what? 14 days. We already discussed in our earlier example, when you want to convert the yearly volatility into days volatility, what you are supposed to do? You have to calculate here 14 days volatility T B 14, sigma 14 is nothing but sigma daily into root over 14. So, sigma daily is our 6.198 root over of 14. If you calculate this, it will be something whatever this give you, this is our sigma for 14 days, sigma for 14 days. So, how you could do it? 14 days root over you take 14 days, suppose 14 days root over around 3.8 something will come. So, if you multiply 0.6918 into, it will be around 3.6 will come, something around like that, 3396, 3.6 or 7. Suppose we are assuming 3.7, they multiply this through 3.7, then it will give you the 14 days volatility. Let us multiply, suppose it will be coming around, if you calculate that actual amount in Excel sheet, it will be coming around 0.6918 into 3.7, it will give around 2.56, 2.559. So, 14 days volatility got 2.559. You V0 is our 2.559. The question is here, what is the confidence limit? When we discuss about this, we have to also discuss about the confidence limit. Confidence limit is what? What is our confidence that same volatility will continue? So, for confidence limit also you have to factor here. So, confidence limit is here, you have to go for the different kind of confidence limit. So, here an age holding period is 14 days, you have to multiply 14 days. So, our calculation is here, if you multiply all these 3, then you will get the 1 standard deviation here. So, 1 standard deviation, because we discussed our earlier slide that the var depends upon the confidence limit. So, our var we got that, so P0 is 10 million, then we also got what is called the T period, T is 14 days, as sigma 14 we also got 2.559, and now these 3 we need for calculation of var. So, suppose you are 99% sure, same volatility will continue, then 99% sure what we have the positive negative side of the volatility calculation, that is we know that our calculation process will be positive. So, our standard 99% sure the normal distribution curve will be something around, the here x bar minus 99% sure will be 2.33 as standard deviation and positive x bar 2.33 standard deviation. So, now 99% sure. So, our value at risk will be 10 million into 14 into your var will be 14 days into 2.33 into standard deviation is 2.559. This is our standard deviation calculation process. So, the 99% sure we have this is the our value at risk. What we will get out of this? Everything, this is the only dollar, others are number. So, what is the maximum loss we can have, that we are estimating. Value at risk means the tail minions value, tail minion dollar, what will be the maximum loss we can have. So, if you multiply this, we will get the what is the tail minion, I have 10 million with a volatility of 2.59 daily 14 days volatility, what is the maximum loss I can have, I am calculating it. Similarly, if you do for other thing, suppose I have confidence of something around 60, something around 95% confidence. So, 95% confidence, I have x bar minus 1.65 standard deviation and x bar plus 1.65 standard deviation. So, my area is here. So, my calculation of standard deviation of value at risk will be P0 into V0 into H. So, my P0 is 10 million US dollar, my V0 is earlier my V0 daily volatility, my 14 days volatility was, I am calculating for 14 days, volatility calculation is for 14 days. So, my daily 14 days volatility 2.559 into I have confidence of 95% into 1.65 into my H0 holding period is 14 days. So, this will give me the maximum loss when I am sure of 95% confidence. So, that is the calculation process will come over there. So, what we are doing here? Similarly, if you calculate for 1 day VAR, that is for 1 day, means suppose for I am confident about only 68%, then only 68% confidence, my standard deviation is 1 standard deviation here, 1 standard deviation here, I am confident about small area. So, here while for 90, 68% sure, 68% calculation, 68% I am sure. So, where for 14 days for 68% will be 10 millions into daily volatility 14 days volatility 559 into 1 into 14 days. So, this will give you the maximum loss when I am sure about 14, where about only 68%, that is 1 standard deviation I am my volatility I am sure. So, this is the process of calculation of VAR. VAR only give us what is called the probable expected potential loss. It is not giving us any kind of actual loss. The volatility continues same manner. What is the expected loss I will have in my foreign currency calculation? Foreign currency which is open to me. We have not purchased any kind of risk management product. So, what is the relevance of VAR? Relevance for VAR is many things. So, when I discuss about relevance of VAR, where I am using this VAR in actual foreign currency market. Foreign currency market limit setting, because foreign currency dealers are there, they trade in foreign currency market. So, for how much loss they should have, the maximum loss they can have in their foreign currency, the limit setting they will use it. Similarly, common denomination, because for calculation of loss, some kind of information I should have, because I cannot continue with the open position. I have to understand that if there is a volatility, how much loss I should have. So, meaningful information to management, VAR indicate. Third thing, performance evaluation, 3-4 traders are there, each trader has some kind of portfolio given to him. How he can evaluate the traders on the basis of value at risk? What is the value at risk? What is the risk they are carrying in their position? That is value at risk provide some kind of information or performance evaluation about the traders. Similarly, what I am estimating from the value at risk? Risks I am estimating. To minimize the risks or to absorb the risks, I should have capital with me. So, allocation of capital also important, and that will also provide through the value at risk model. And another thing is the foreign exchange dealing rooms. So, front office we have a foreign exchange dealing room that designed on the basis of the value at risk model. Value at risk model provides some kind of information how you can design the front office or the mid office, back office. In front office, dealer with the dealing room, they use the value at risk significantly to minimize the loss, to avoid the potential loss, or to create some kind of risk management product to immune their position. That is very important for the front office dealing of the front office dealers, where value at risk help them significantly. So, when I go for something more, the functions of treasury, other thing, interbank dealings room. So, functions of treasury forex also that value at risk help in designing what is called operational losses, translation losses, management position of the position of exchange risks. These are the some other area where value at risk model generally applicable in foreign currency market. Similarly, in limit setting also foreign currency day limit, because one day how much limit I should have in tradings, the day limit trading also you can design from the value at risk. Overnight limit, the next overnight within the overnight limit how much loss they should have, maximum loss the balance sheet or the portfolio can observe, that also can be prepared through the value at risk model. Cut loss, when cut loss means when I have to stop my trading, the loss with loss maximum loss I can have, the cut loss I have to cut loss limit also set through the maximum loss limit set by the value at risk model. Credit and counterparty risks, because counterparties are there, their position they have also bear risks, their risk can be analyzed through value at risk model also. Credit and counterparty risks also possibilities are there, you can use the value at risk model. Each currency limit, each way, because each currency has their own volatility, we can say you can put a limit on the currency, each currency trading pattern, trading side for the through the value at risk model. Similarly, gap analysis, because when I have export import buying sellings are going on, I have to prepare a gap for my foreign currency open, foreign currency close position, foreign currency inflow outflow. So, on that basis I can put a gap limit through the value at risk model. Value at risk model very useful, particularly in foreign exchange market, because exchange rate is highly volatile. We have to keep constant touch in the movement of exchange rate, and this constant touch only possibilities are there when have value at risk model, because in a foreign currency dealing room we are not trading with the one currency, many currencies are there. Each currency have to have a target limit, each currency I have to have a gap limit, each currency I have to limit setting for each currency. These only possibilities are there on through the value at risk model. Thank you.